Imagine a financial empire, built on the shifting sands of a digital frontier, collapsing in a matter of days. Billions of dollars erased. Reputations shattered. Trust utterly annihilated. This isn't a dystopian novel, it's the true story of FTX, once a titan of the crypto world, and its enigmatic founder, Sam Bankman-Fried. He was hailed as a visionary, a philanthropic genius, the responsible face of a volatile industry. But beneath the carefully cultivated image lay a staggering deception, a web of lies and illicit transactions that would lead to one of the largest financial collapses in history. How did it happen? How did a seemingly brilliant mind orchestrate such a catastrophic downfall, leaving a trail of devastation that rocked the global financial markets and exposed the dark underbelly of unchecked ambition? This is the anatomy of an $8 billion crypto collapse. Our story begins with Sam Bankman-Fried, or SBF as he was widely known, a figure who emerged from the prestigious halls of MIT with a background in physics and a knack for mathematics. His early career at Jane Street Capital, a quantitative trading firm, honed his skills in high-frequency trading and arbitrage, the art of profiting from minuscule price differences across markets. It was a world of algorithms, lightning-fast decisions, and immense potential, skills he would soon unleash upon the burgeoning world of cryptocurrency. In 2017, SBF ventured into the digital asset space, quickly identifying a lucrative opportunity, the kimchi premium, a phenomenon where Bitcoin traded at a significantly higher price in South Korea than elsewhere. He launched Alameda Research, a quantitative trading firm designed to exploit these inefficiencies, raking in millions in profit. Alameda's success paved the way for SBF's next, far more ambitious project, FTX. Launched in 2019, FTX was envisioned not just as another crypto exchange, but as an exchange built by traders, for traders. It offered sophisticated derivatives, futures, and leveraged products that appealed to institutional investors and seasoned crypto enthusiasts alike. Unlike many of its competitors, FTX quickly gained a reputation for its user-friendly interface, robust technology, and responsive customer service. SBF, despite his unkempt hair and preference for t-shirts and shorts, became the unlikely, yet undeniably charismatic, public face of this rapidly expanding empire. He moved FTX's headquarters to the sunny Bahamas, a move that symbolized both its global ambition and its detachment from traditional financial regulations. FTX's growth was explosive. It signed massive sponsorship deals, partnering with sports stadiums, Formula One teams, and even snagging celebrity endorsements from figures like Tom Brady and Stephen Curry. SBF presented himself as an advocate for responsible regulation, appearing before Congress, and donating vast sums to political campaigns, positioning himself as a benevolent force shaping the future of finance. Crucially, he championed effective altruism, a philosophy advocating for the most impactful ways to do good in the world, often through charitable giving. This persona cemented his image as a trustworthy, even ethical, leader in an often unregulated and chaotic industry. He wasn't just building a crypto empire, he was, supposedly, building a better world. The crypto community, hungry for legitimacy and stability, embraced him and FTX with open arms. They saw a future, built on innovation, led by a genius. But beneath the veneer of philanthropic innovation and transparent operations, a dangerous secret festered, one that would prove to be FTX's undoing. The relationship between FTX, the exchange where customers deposited their funds, and Alameda Research, SBF's trading firm, was not merely one of sister companies, it was a relationship riddled with unprecedented conflict of interest and, ultimately, outright fraud. The first cracks in this seemingly impenetrable facade appeared in November 2022. A bombshell report from CoinDesk revealed that Alameda Research's balance sheet was alarmingly fragile. Its assets were not diversified holdings, but overwhelmingly comprised of FTT, the native token issued by FTX itself. Essentially, Alameda was borrowing heavily against a cryptocurrency created and largely controlled by its own founder's exchange. This was a house of cards. If FTT's value plummeted, Alameda, and by extension FTX, could be in grave trouble. The market responded with immediate alarm. Just days after the CoinDesk report, Changpeng Zhao, the CEO of rival exchange Binance, announced he would liquidate all of Binance's FTT holdings, citing recent revelations. This move, whether motivated by genuine concern or strategic rivalry, triggered a catastrophic cascade. Panic spread like wildfire through the crypto community. Customers, fearing the worst, rushed to withdraw their funds from FTX. It was a classic bank run, but on a scale rarely seen in the digital age. Millions of users, suddenly distrustful, flooded the exchange with withdrawal requests. Initially, FTX struggled to keep up, then it buckled. Within hours, the impossible became horrifyingly real. FTX announced it was halting all customer withdrawals, effectively locking users out of their own funds. The company, once valued at tens of billions of dollars, was facing an immediate and dire liquidity crisis. Sam Bankman-Fried scrambled for a lifeline, desperately attempting to secure bailout funds from investors and, ironically, from Binance. CZ initially signed a non-binding letter of intent to acquire FTX, offering a flicker of hope. But that hope was extinguished just 24 hours later. After a brief due diligence process, Binance backed out, citing reports of mishandled customer funds and alleged U.S. agency investigations. The true depth of FTX's financial black hole was simply too vast. The jig was up. On November 11, 2022, FTX, Alameda Research, and dozens of affiliated companies filed for Chapter 11 bankruptcy in the United States. Sam Bankman-Fried resigned as CEO, replaced by John Ray III, a veteran restructuring expert famous for overseeing the liquidation of Enron. Ray's initial assessment was damning, and delivered with a chilling clarity. He stated he had never seen such a complete failure of corporate controls and such a complete absence of trustworthy financial information. He described unacceptable management practices, including the use of company funds to buy luxury real estate for employees in the Bahamas, commingling of corporate and customer assets, and a distinct lack of any recognizable corporate governance. The revelations that followed were even more shocking. It emerged that customer funds, deposited into FTX, had been secretly diverted to Alameda Research to cover its trading losses, effectively using customer money as a personal piggy bank. A backdoor in FTX's accounting system allowed Alameda to borrow billions without triggering risk parameters. This wasn't merely mismanagement, it was an alleged, calculated fraud on an astronomical scale. The initial estimate of missing customer funds quickly ballooned to over $8 billion. Just weeks after FTX filed for bankruptcy, Sam Bankman-Fried was arrested in the Bahamas at the request of the U.S. government, and swiftly extradited. He was indicted on multiple charges including wire fraud, money laundering, and campaign finance violations, facing decades in prison. The boy wonder, the crypto savior, was now a fallen titan, exposed as potentially one of the greatest financial fraudsters of our time. The collapse of FTX and the downfall of Sam Bankman-Fried sent shockwaves throughout the global financial landscape. Millions of individuals and institutional investors lost their life savings, their retirement funds, their trust. The ripple effect devastated the wider crypto industry, erasing billions from market capitalization and triggering a crypto winter that saw prices plummet and investor confidence evaporate. It delivered a massive blow to the industry's already precarious reputation, fueling calls for urgent and stringent regulation to prevent such catastrophic failures from ever happening again. The case became a stark reminder of the inherent risks in unregulated markets and the seductive allure of unchecked power, especially when combined with a sophisticated, yet ultimately deceptive, public persona. The narrative of effective altruism SBF champion now stands as a chilling testament to how a noble philosophy can be twisted into a facade for greed and deception. Was he a brilliant but careless operator overwhelmed by the scale of his own ambition, or was he a sophisticated con artist who deliberately built a house of cards from the very beginning? The ongoing legal proceedings aim to uncover the full truth, but the lessons are already clear. This saga underscores the critical importance of transparency, robust corporate governance, and independent oversight in any financial system, digital or otherwise. It is a cautionary tale about trusting charismatic figures, even those who claim to be doing good, and a stark reminder that in the absence of accountability, even the most innovative ventures can become instruments of colossal fraud. The digital Wild West may promise boundless innovation, but without strong guardrails, it can also become a dangerous playground for deceit. If you found this deep dive into one of the world's greatest financial collapses compelling, make sure to like this video, subscribe to our channel for more exposed documentaries, and hit that notification bell so you don't miss our next story. What other financial schemes or market collapses do you want us to investigate? Let us know in the comments below.